Imagine Wall Street in November 1963. President Kennedy has just been assassinated. The nation is in mourning. The markets are fragile. Suddenly, news breaks of a massive corporate fraud involving vegetable oil. One of America's most trusted financial institutions, American Express, is facing potential bankruptcy. Its stock crashes by roughly 50%. While the world is selling in a panic, one man in Omaha is quietly buying. The event was known as the salad oil scandal. A commodities trader named Anthony DeAngelis had pulled off one of history's most audacious conspiracies. The goal was simple: use inventory of soybean oil as collateral to borrow millions from banks. The problem was the tanks were fake. DeAngelis had filled massive storage tanks almost entirely with seawater, floating just a few feet of vegetable oil on top to fool inspectors. When the truth came out, the loans defaulted. American Express, which had guaranteed the warehouse receipts, was suddenly on the hook for roughly $60 million. In today's money, that is over $500 million. Wall Street viewed this as a death sentence for the company. The liability exceeded the company's entire equity base. The stock fell from $60 to $35. But 33-year-old Warren Buffett saw something different. He didn't rely on the headlines. He relied on Scuttlebutt, a method of gathering on-the-ground intelligence. Buffett went to Omaha restaurants and stood near the cash registers. He watched customers pay for their steak dinners. He went to local banks. The question was, did the scandal affect the customers' trust in the product? He noticed a crucial detail. Despite the headlines about fraud and bankruptcy, customers were still slapping down their American Express green cards. Travelers were still buying Amex checks. The scandal was a financial blow to the corporate balance sheet, but it had not damaged the consumer franchise. The brand was intact. Buffett realized the market was pricing the company as if it were going out of business. He saw a temporary crisis creating a permanent opportunity. His analysis relied on three core pillars. Core Pillar 1. The economic moat. Buffett understood that American Express had no serious competitor. It was a monopoly of trust. As long as merchants accepted the card and travelers bought the checks, the company could print money. The fraud was a one-time expense. The earnings engine was untouched. Core Pillar 2. Aggressive conviction. Most fund managers diversify to protect against ignorance. Buffett believed in concentration when the odds were heavily in his favor. In early 1964, Buffett began buying. He didn't just take a small position. He poured roughly $13 million into the stock. This represented 40% of his partnership's total assets. It was a staggering bet that would terrify a modern portfolio manager. Core Pillar 3. Patience. He knew the lawsuit settlements would take time. He wasn't looking for a quick bounce. He was looking for the business to compound over years as the fear subsided. History proved him right. American Express settled the claims, and the business continued to grow. Within 5 years, the stock price had tripled. Buffett eventually made a profit of roughly $20 million on that single idea. It remains one of the most famous examples of contrarian investing in history. Practically, the lesson for us is to distinguish between news that damages a stock price and news that damages a business model. Buffett bought because the oil scandal didn't stop the card business. If this story helped you see market panic in a new way, subscribe to Market Cafe for more advice from investment legends.